Hello, my name's David Miller and I'm the manager of Nexus Global Solutions portfolio and the co-manager of Dynamic. And I'm speaking to you from the Quota Cheviot office in London. It's early February, 2018 is in full swing now. The New Year lull is a distant memory. And I'm on the spot because we're right in the middle of a market setback that took hold towards the end of last week and it's still going on as we speak. So let's start with the facts. Up until the close of business yesterday, both portfolios were down about 2% year to date. So we're doing our very best to protect capital despite the difficult trading environment. And I think that's really important. We've talked about it before. I've said about stock selection, how important that is. Liquidity is important, quality is important, diversification is important. And all of these things pay off during difficult times. So that's where we are at the moment. The portfolios are structured. Dynamic is about 95% invested in equities, so a bit of cash, but fairly fully invested. Solutions, the balance is around 55 in equities, 30 odd in fixed interest and cash, with the balance in alternatives. That's the structure we've been running with for quite some time now, and that is what is helping at the moment, as I said. In terms of where next, I think we've got to look at why markets have fallen away before we get to the future. The good news is that economic growth is continuing to accelerate all around the world. The company results season is in full swing. US earnings, for example, are up on average 13% year on year, and a lot of the statements from the chief executives are positive about current trading into this year. This is good news. And I think the issue is that perhaps we've just got a bit too much good news going on at the moment. We've got the economy, we've got the companies doing well. In the US, we've got tax cuts, and now there seems to be a policy within the Trump administration to talk down the dollar. So a weaker dollar on top of all of that. And that is a lot of good things going on at the same time for the US economy. The risk is, I think, that we might see a bit more inflation. That's what's taken hold in the last few days. Higher inflation means that the central banks will have to put up interest rates more than expected. And at that stage, the short-term traders, those investing with borrowed money, and quite a lot of it, are in trouble, and they've been selling. And so very quickly we saw a sell-off in markets without any real change in the underlying strength of what we're investing in. We're investing in companies that do real things in the real world. So we have to take a step back and make an assessment about the future. And it is difficult at the moment. I think the volatility that we're seeing now may well continue for some time to come. But at the moment it's contained within a certain part of the financial market and not spreading out into the rest of the economy. And as I said, not having a great effect on the portfolios that we're responsible for. So, is this 1987 where we had a quick, short, sharp shock and pretty quickly it was back to business as usual? Or is this a rerun of 2007 which morphed into the credit crunch, recession? We all know the story there. Our judgment is that it's early days. There's no benefit to us being precipitative about this. We can be patient, we can watch to see what the numbers look like. But I think at this stage we're looking to buy into companies that we think we have confidence in, and if we can do that at a cheaper price than just a few weeks ago, then that's what we're going to be looking to do. So that's where we stand at the moment. I look forward to reporting to you in a month's time. Thank you.